All right, so this is the review session for EGME 401, Engineer Economics and Professionalism for the second midterm for the fall 2020 semester. Okay, so I looked at the poll on Canvas, and these were the three topics that seemed to come out on top. So number one was taxes and depreciation, and then the next two topics were inflation and break-even analysis. So there was a tie at 2 and 3, but there's a little bit more with regards to inflation. So I'm going to cover that. I'm going to focus on that one first. I just like last time, I'll have time to cover the first two topics, and then whatever time is left at the end, probably after an hour, we'll kind of just very briefly go over the last one. Okay, so the first one is going to be on taxes. Okay, so taxes was a pretty big unit for us. So it spanned, I think, a little bit over a week. Okay, and the whole thing with our taxes unit was to help us determine how much income tax that we have to pay for a certain project. Okay. So let's give this title. Right. So so the whole idea with the tax is that anytime you make money in America, you sell a good or you sell a service, you have to pay a percentage of that to the government. Okay. Okay. And so, it might seem simple because, a lot of times we just, you think about your sales tax, you buy a certain something from the store and you pay just a percentage of what the price was, right? So you say like the tax is like 8%, you buy, a $10 meal, you pay 8% of that, which is 80 cents in tax, right? But for income taxes, it's a little bit more complicated because, we have these things in America called deductions, okay? And so what deductions allow us to do is to basically reduce our amount of taxable income. Okay? And so when we first went over our taxes unit, we had this formula right here. Okay. So our taxable income, we took it as a formula, and so the first term was just our gross income. And so gross income, you could kind of think of this as the total amount of revenue or the total amount of money that you make from a project. Okay. From this, you can subtract what's known as ordinary or necessary expenditures. Okay. And so the second one is pretty important because oftentimes when we're doing these calculations, we often forget it. But what this basically encompasses is that any money that you have to pay out for something that will last less than a year, including labor, that is necessary to run your business. Okay. Okay. And so some of the most common costs that get lumped into here are things like labor costs, so paying your employees. And so, if you work for someone right now, what your company's doing is they're taking your salary and deducting that from their taxes, from their taxable income, which makes sense because once you get the money, like you have to be the one that pays taxes. So if the government charged both, that amount for the company and for you, it's like they're the government's kind of double dipping. So that's a big one. And so another one that you'll see often, at least in terms of our problems, is any kind of necessary maintenance or overhaul cost that's associated with the machine. Okay? So oftentimes you'll buy a piece of machinery, and it's going to cost money each year to maintain the machine or to upkeep it. or you might need to go over some major renovations or major repairs, at a certain year. And so those fall under the category of ordinary and necessary expenditures. So you can deduct that from your taxable income as well. Okay. Right. And so the last category that we'll go over is depreciation charges. Okay. And so depreciation, this is kind of the big topic for this unit. And so the idea with depreciation is that whenever you buy a big piece of machinery or big piece of equipment, I think an example that we did a lot was like delivery trucks or any kind of something that's supposed to last for more than 1 year. These purchases are often really, really big, right? And so what can happen often is that the cost of a big piece of equipment can outstrip your entire gross income from that year. So if you deduct that all from your taxes right away, then it's going to result in a really big tax break. But the thing is, with these large pieces of equipment that last more than 1 year, that's not really fair to kind of deduct the entire cost right up front. Because what you can do in that case is that you can buy a really big piece of equipment, say like, a fleet of trucks, deduct that entire cost of the trucks from your taxes in that year, and then sell the trucks the next year for of course the amount of money is going to go down, but it's not going to be, you're still going to recoup a ton of money. So that's kind of a really, a way to kind of exploit the tax system if you really want. It would be a lot of trouble to do so, but you can do that. Okay. And so the idea behind depreciation is that, these large pieces of equipment that last for more than 1 year, they gradually lose value over time, right? So think about, your car, right? So you buy a new car, as soon as you drive it off the lot, it loses some value from what you paid it as, right? And as you use it, year by year, month by month, the value of that car is going to go down with time. Okay. And so basically any kind of asset that lasts, longer than 1 year, that's used to run your business, will be subject to depreciation charges because that amount gets decayed every year. Okay. And so, in terms of taxes, instead of, deducting the entire cost of a large asset up front, what the government allows you to do instead is to basically deduct the amount that asset lost value, right? And so say, you use your car for a year, okay, and the car costs $20,000. And over the course of that year, let's say that the car lost about $5,000 worth of value. Okay? And so if you sold that car after year 1, then you would sell it for $15,000. And so what this basically says that if you use your car for business, which is the big caveat, then what the government will allow you to do is say, since your car lost $5,000 worth of value this year, you can deduct that $5,000 from your taxes. Okay? And so the thing with depreciation is that it kind of connects two ideas that kind of seem a little bit disparate. And so first of all, it connects the idea of deducting things from your taxes. So you have this kind of tax angle. And the other side of it is, the fact that large pieces of equipment will decay in value over time. Okay. And so depreciation, at least the way we covered it, is kind of like the combination of these two things. Okay. And so basically, to kind of sum it up, whenever you buy a large asset, whatever value that it loses over a certain year or for a certain time period, you can deduct that from your taxes. Okay. Okay, so that's kind of the idea behind depreciation. Okay, and so once you compute your taxable income, that's kind of the hard part is how much taxable income you owe. Computing your taxes is actually very simple from there. And so taxes is simply going to be your taxable income multiplied by the tax rate. Okay. And oftentimes for our problems, we use the federal tax rate, at least at the time that the textbook was written, which is 21%. Okay. Okay. And so, that's the whole idea behind depreciation, at least in concept. But actually implementing it in practice, will be a little bit different. Okay. And so the whole, I would say the most important thing when you're doing these tax calculations is that, just like everything we're doing in this class, the arithmetic is usually not that difficult. It's mostly just multiplying numbers and just adding them together. But for taxes, the most important thing is that you have to be organized. Okay. I know this is probably something that stressed you in a lot of your classes, but especially for tax calculations, being organized is extremely important because you're going to have a lot of numbers flying around over long periods of time, lots of deductions, lots of depreciation. So, just to make sure that you're computing the things that you need to do, it's really important to be organized. So, when you guys are doing these tax problems, not only on the homework, but also, of course, for your for the midterm, I really want you guys to write out the full table. So that tax table, that we went over in class, where you start with before tax cash flow, and I'll do one of the homework problems just so you can see. I want you guys to write down that full table, because that's going to help you stay organized. It's going to help me grade too, because the worst thing in the world is to grade someone's work that's extremely messy. Okay, and so please use the table and please stay organized because it's going to help kind of everyone in the long run. So I know it's kind of annoying to draw that table, but I think it's usually the best way to do this. Okay. And so before we get to an example, I do want to review kind of the four different methods to compute depreciation. Okay. Right. And so I'll review kind of each one just kind of briefly. But basically, the idea behind these four methods is there are four different ways to determine how much value your asset is going to lose per year. Okay. And so the reason we have these four methods is for tax purposes, because in terms of all the really big expensive assets out there, there's way too many to count. Okay. And so it'd be literally impossible for tax accountants out there to basically look at and appraise the value of your piece of equipment every single year for tax purposes. And so to make things simple, at least for tax purposes, we have these four methods that kind of determine at least from a tax perspective how much value an asset will lose per time. Okay, and so these aren't perfect because there are some pieces of machinery that lose value faster than other ones. Okay, but we have these four methods just to keep things simple because the volume of tax information that gets sent through that gets processed through the government each year is just it's just immense. So if we need some simple rules like this in order to kind of make it possible to kind of process these in a practical amount of time. Okay, so let's start with the simplest one. And so our simplest method is straight line depreciation. And so in straight line depreciation, what happens is that your asset is going to lose a fixed amount of value each year. Okay. And so the way that you compute this this fixed value or this fixed amount is by this formula. Okay. Okay. And so we have a formula for the annual depreciation. Okay. And so the formula is given by B minus S all over N. Okay. And so let's define these variables. So B is going to be our initial cost. Okay. S is our salvage value. Okay. N is our number of periods. Okay. Right. So all this is, information that's usually very easily obtainable from our problems. Okay. And so once you do that, then you get a fixed amount that the value kind of decreases each year. Okay? And so the reason it has this name straight line is that the path from your initial cost down to your salvage value is literally just a straight line. Okay? And so if we have N here on the x-axis, okay? And we say B right here is our initial cost, and S down here is our salvage value. If we lose a fixed amount each year, then we basically draw a straight line from the initial cost down to the salvage value. Okay, hang on. I'm gonna turn on the light real quick because it's getting a little bit dark. And so straight line is the simplest one that you can do. So you basically just take the initial cost, subtract the salvage value. So most of the time in these problems, we're going to assume a salvage value of 0, and then you just divide by n, okay? And then in the column for your tax table where you write the depreciation, you just write this amount, you know, for each entry there, okay? And so straight line's nice because it's relatively simple, okay? Okay, and so that's the first method. And so the next method that we went over is called declining balance. And so the idea with declining balance depreciation is that, you know, we're going to, instead of using a fixed amount each year, you know, the rate at which the depreciation, or at least the rate at which the value decreases is a fixed number, okay? Okay. And so to get the rate at which you will depreciate with, you basically just use this formula, okay? Right, so you do 2 divided by n times the previous book value, right? And so it was with this method that we introduced the idea of book value, okay? Right? And so book value, you can kind of think of it as just, you know, how much value your asset has left, okay? Okay. And so the way that we computed this, okay, is we take first the initial cost, and then from the initial cost, we subtracted all of the depreciation charges to date. Okay. And so that's all the depreciation charged to date. So if you compute the book value in like year, you know, 7, you're going to subtract the depreciation, you know, all the depreciation values from year 1, 2, 3, 4, 5, 6. Okay, so it's all the previous years, and that's how you get your book value. Okay, and so usually you're going to compute your book value incrementally. So, you know, from our tables, we usually go row by row, right? And so we first do our first row, we get the book value, and then for the next row, we compute the depreciation and then subtract that from the previous book value. So, you know, this formula I think makes it seem harder than it actually is, but it's really just, it's literally just how much value your asset is worth right now. Okay. And so what declining balance basically says is that, you know, the amount of value that your asset loses is some percentage of how much it was worth the previous year. And so let's say if we have an n is equal to 5, right? So I think that was that was what we use in our example. And so with n equal 5 is basically what we're saying is that, you know, we're going to lose 40% value for our asset every single year, okay? And that's not 40% of the initial cost, that's 40% of however much it was worth in the previous year, okay? Okay, so that's declining balance. And now let's go over bonus depreciation. Okay. And so bonus depreciation is not really a method all by itself, unless it's 100% bonus depreciation. But you can use bonus depreciation in conjunction with some other ones, okay? And so what bonus depreciation, just like the name kind of suggests, is that this is depreciation that you can just take right off the top, okay? So this is a relatively new development, and it's it's meant to kind of basically encourage encourage businesses, okay, and encourage the economy, because what this will basically allow businesses to do is to take a large percentage of their very large equipment costs and then deduct that from their taxes. And so what that does is it basically gives businesses more money on hand right now in order for them to stimulate their business, invest in more stuff, pay more staff, and things like that. So bonus depreciation, even for relatively modest amounts, is still really, really nice. Okay, and so just as an example, right? And so let's say that we have an asset that costs $100,000. Okay. Okay. And this $100,000, we can say out of this, 40% will be eligible for bonus depreciation. Okay. And so with 40%, we basically take 40% of our initial cost. And so our initial cost here is 100,000. So 40% of that is 40,000. Okay. And so this 40,000 we can deduct from our taxes in year one. Okay. And then whatever's left after the bonus, we have to use some other depreciation scheme for this. Okay. Okay. And so that other scheme could be something like straight line depreciation, it could be declining balance, or it could be the next one that we go over, which is MACRS. Okay. Okay. Right. So this is the last depreciation system that we went over, and so it stands for the Modified Accelerated Cost Recovery System. Okay. And so I'm not going to go over all the specifics for MACRS just because it's a lot of kind of details. But the idea with MACRS is that you assign a property class to whatever asset that you have. Okay. And so the property class, it depends on what kind of asset it is, right? And so, in the notes, we basically went over things like the property class for like a 3-year property, a 5-year property, a 7-year, 10-year, 15-year, and 20-year. And so, some examples of this is that if you have like an aircraft, right, like an airplane, say like, your Southwest Airlines, then your aircraft classifies as a 5-year property, okay? And so for government purposes, your aircraft is going to last 5 years. Okay, and then what you can do from here is that once you've identified the property class, the amount of depreciation it takes per year is determined by a table. Okay. Okay. And so again, all that information is kind of better explained in the notes, but I think if I wrote it down here, it would kind of take too much time. Okay? But the most important part for MACRS is that you assign the proper property class to it, so that you can assign the right percentages. Okay. Okay. So that's a summary of all of the all the depreciation rules. Okay. And so it's a lot of definition and a lot of concepts. And so I think the next thing to do is to do an example to kind of illustrate this in action. Okay. And so for this example, I'm going to redo a problem from homework 4, okay? But I'm going to add a little bit of twist to it just so that you can kind of see a difference, okay? And so let's do problem 4B, okay, on problem on homework 4. Okay. And so in 4B, basically it tells us to repeat problem 2B, but now consider a federal income tax rate of 21%, okay? And then what it wants us to do, it wants us to compute the after-tax present worth of both wind tunnels. Okay? So I'm just going to do one for this case, for this review session, just because I want to get to inflation, but hopefully it'll be good. Right? All right. So the homework problem asks you to use straight line depreciation with an assumed salvage cost of 0. But for this example, let's do a combination. So let's do a 50% bonus. Okay. And then after the 50% bonus, let's say that the rest of the depreciation is made up by straight line. Okay. Okay, and so let's do the one tunnel design, okay? With these tax rules. Okay. All right, so let's go back up to problem 2B. Stall a little bit while I scroll up there. Okay. Okay, so for the one tunnel design, we have the following numbers. So let's, if we go back to 2B, we say that we have an initial cost of 250,000. Okay. And the revenue is 77,500 per year. Okay. Over 8 years. Okay. And so that's all we got. So the cash flows are relatively simple. Okay. All right. So first thing to do, let's compute the depreciations. Okay. And so we have 50% bonus. Okay. And so to compute this 50% bonus, we just take 50% of the initial cost. Okay. And so we take 50% of this, we have 125,000. Okay. Okay. And then after we compute that, we can say that the rest of this is going to be made up with straight line. Okay. And so if we did 50% bonus, then after the bonus, we have 125,000 left. Okay. Okay. Because we did 100, we took 50% of 250,000. And so right off the top, we depreciated 125,000. So 250,000 minus 125,000 is going to be 125,000. Okay. And so our straight line rate is going to be whatever we have left. So 125,000. Okay. We assume a salvage value of 0. Okay. And then we divide this by the number of years. Okay. And so we're going to do 125,000 divided by 8. Okay. Which is 15625. Okay. Right. And so each year, including the first year, we're going to have a depreciation charge of 15,625. Okay. All right. So this is the behavior for years 2 through 8. Okay. In year 1, we have the combination of both of these. So we have 125,000. Okay. Plus the year 1 charge. Okay. And so year 1, our total depreciation is going to be 125,000 plus 15,625. And so that's 140,625. Okay. Okay. And so now that we have all of our depreciations, we have our initial cost, and we have our revenue. Now let's start to put this into our table. Okay, so let's write out our full tax table. Okay, so our tax table starts with the year. Okay, and so we have 8 years. So we're going to start with 0, 1, 2, 3, 4, 5, 6, 7, 8. Okay. Next, we have our before tax. Before tax cash flow. Okay. All right. Next, we would normally have a column for any necessary expenditures, so any kind of maintenance or labor that we can deduct from our revenue, but we don't have that in this case. Okay. Next, we have our depreciation. Okay. Or how much we're going to deduct from our taxes based on our, based on our depreciation rules. Okay. Next, we have our taxable income, or how much taxes we're going to pay, or how much of our income we're going to pay on, okay, which is going to be our before tax cash flow minus our depreciation. Right. Next, we have our taxes. Okay. And then finally, we have our after-tax cash flow. So after we paid out our taxes, how much money are we going to have left? Okay. Okay. And so to start this table, let me write in our initial cost. And so our initial cost was $250,000. Okay. And so we don't depreciate anything in the first year. Okay. And so every year after that, we have a revenue of, how much was it? It was $77,500. Okay. So let's write all of that in. Okay. And so that's how much making before our taxes. Okay. Okay, so next let's write in our depreciation. Okay, so remember we have a special first year, so our first year is going to be fairly large because of our bonus. And so let's input the number that we computed on the previous page. So it's going to be 140,625. Okay, and then every year after that we just have our regular straight line rate. So it's going to be 15,625. Okay. All right, and then to get our taxable income, we're just going to subtract our before tax cash flow minus the depreciation. Okay, and so in the first year, since our depreciation is larger than our revenue, we're going to have a negative number here. Okay, so use a different color. So this is going to be minus 63,125. Okay, and then every year after that, let me punch this in my calculator. We're going to have a positive 61,875. Okay. And so to compute our taxes, we just take our taxable income and we multiply it by 0.21. Okay. And so the first year we have 62,125 times 0.21, and we get a minus, use a different color, green. And so our taxes in the first year, we're actually going to get a tax credit because we're negative here. Okay. And so we have 13,000 minus 13,256.25. Okay. And then every year after that, we're going to pay $12,993.75. Okay. Okay, and so after we do all that, we can finally get our after-tax cash flow, which we get from taking our before-tax cash flow and then just simply subtracting out our taxes. Okay, and so in this first year, we're actually going to add this, right? So we're going to have 77,500 plus our 13,256.25, and so in the first year, our after-tax cash flow is going to be 90,756. 90,756 and 25 cents. Okay. And then every year after that, we're actually going to pay taxes. Okay. So we're going to take 77,500 minus 12,993.75, and that's 64,506.25. Okay. And that's going to be true all the way down. And so after we do all those calculations and we get this final column right here, we can use this to compute our present worth, okay? And so, you can basically draw a cash flow table or a cash flow diagram that looks like this. Okay? Imagine there's one more, okay? And so first we have our initial cost, which we're gonna put here, okay? And then for all the other up arrows, we're going to take all the entries from this table and then put them on all these up arrows here, okay? And then you can compute the after-tax present worth, okay? And so if your calculations work out nicely, you can do like a uniform series, okay? But what tends to happen with these kind of tax problems is that the cash flows get pretty complicated. So you might have to do each year individually and then bring them back to the present day using a P over F expression, okay? All right, so that's tax calculation. So remember, the most important thing with taxes is to just stay organized. So if you see a tax problem on the exam, I really want you guys to write out a table like this and really kind of fill in all this stuff. So I know it takes a while, but helps you stay organized, and it helps me with the grading as well. So I think it's helps kind of everyone involved. Okay, so that's taxes and depreciation. Okay, so that took a little bit longer than I wanted. And so the next thing on the list is going to be inflation. Okay, and so inflation was the most recent topic that we covered in the class. Okay, and there was a lot to inflation actually. So there was a lot of concepts, a lot of vocabulary, and a lot of different things going on. Okay, but just in a nutshell, basically, inflation describes how prices change over time. Okay. So it's a little bit of a different mindset than everything that we've been covering so far up until inflation. And so everything up until inflation, we had been mostly concerned about, cash. How much cash, how much present worth, how much uniform flow, do we have? And so inflation is different because we're kind of looking at the other side of the equation where we're going to use this cash to actually purchase goods, and then the prices of those goods are influenced by inflation. And so generally what tends to happen is that, prices go up over time. And so, the opposite can happen. So prices can go down. And actually, this pandemic is, something of a situation where, price can go down. But generally prices for things will go up over time. Okay. And so what we generally say is that because of inflation, because we know generally that, if we hold on to our money now, the price of something in the future is going to go up, okay, is that because of inflation, future dollars are less valuable than present dollars. Okay. And so we've already kind of covered this concept when we did time value of money, right? And so because money has a time value, you know, and that any money that you invest that you have now, you can invest it in order to earn more money, okay? And so inflation is kind of, you know, another, it's like a double whammy on top of that, okay? And so any, you know, money that you don't spend on stuff now, you know, it's going to be worse in the future because, you know, the price of everything tends to go up over time, okay? Okay. And so the next thing we went over in class was, you know, the various causes for inflation. And so these are kind of important just to understand conceptually. Right? And so I'll just kind of summarize them here. And so the first was the money supply. Okay. And so just by, you know, the amount of money that's in circulation in the American economy, you know, this is going to affect, you know, the prices for things. Okay. And so remember, you know, the federal agency that's in charge of managing the money supply is the Federal Reserve. Okay. And so every year they print, you know, a certain amount of money to basically make up for, you know, some cash leaving the economy. Okay. And also in a very special situation like this, they can print more money to basically put them in people's pockets so that they can purchase more goods. Okay. And so what can happen is that, you know, if they print too much money, they put basically too much, you know, money out there in circulation, then purchasing power tends to decrease, and prices tend to increase, right? And so, like, if you're a business, you know, and you know that, there's a lot of money out there in the economy, you can raise your prices because then that gives you, you know, more money for your goods, okay? But then if there's too little money in the economy, and so, you know, if the Federal Reserve doesn't print enough, then that causes prices to decrease because there's less money overall, money is more scarce. And so in order for people to buy goods, you know, prices have to go down, okay? Okay, and so the next cause will be in exchange rates. Okay? And this is certainly, this is certainly related to number one as well, but this is, you know, it's a little bit of a separate thing, but it's definitely related to the money supply. And so the relative strength of the dollar compared to other, you know, monies out there in the world, like compared to like the British pound or like, you know, the Mexican peso, you know, depending on that, you know, prices will be adjusted based on that. Okay, especially in, you know, such a global economy, you know, people are you know, going in between countries all the time. Not right now, obviously, but, you know, usually people are coming in and they're bringing their foreign currency with them. And so depending on how strong the dollar is, that's going to, you know, help determine the prices of certain goods. Okay. And especially if you're, you know, if you're an engineering company that does, you know, business abroad, right, you know, which is, you know, very common nowadays. You're either going to buy material out there, you're going to outsource, you know, labor, you know, all kinds of stuff. You know, the exchange rate of you know, the dollar to, you know, or whatever currency, that's going to influence prices as well. Okay. And so the next cause will be cost push inflation. Okay. And so cost push inflation basically happens when, you know, the prices for goods will go increase because the companies that produce these goods basically push their operation costs onto the consumer. Okay, and so you see this kind of most often in the case when, you know, there's increased government regulation or increased taxes on businesses, and so when that happens, you know, the companies don't want to pay for that, and so what they do is they basically make the consumers pay for their increased costs. Okay? And so if there's, you know, ever going to be increased cost for, you know, Amazon, for warehouse workers, you know, that Amazon would have to pay more to keep their workers safer, you know, Amazon's not going to pay for that. You know, we're going to pay for that by increased costs for like Amazon Prime and increased costs for shipping and stuff like that. Okay? And so that's kind of another reason that, you know, inflation can happen. Okay? Okay. And so the last cause that we went over was demand pull inflation. And so this is, kind of like what we discussed in class. This is kind of the classic, supply and demand, right? And so if the demand for a certain kind of product goes up, then the price of that good should also go up so that the money can, or the company can make more money off of it. Okay. And so those are the four, causes. Okay. And so from there, what we did was we kind of launched into a long discussion with a lot of different terms that there's kind of a lot of overlap in between. Okay. And so what I basically want to do is I want to just kind of summarize all those terms. Okay. Okay. And so the first term that we went over was the inflation rate. Right. So the inflation rate is pretty simple. So this is the amount that prices will increase per year. Okay. And so that's, kind of the central thing to this unit. Okay. Next, we have the real interest rate. Okay. And so the real interest rate basically describes how much purchasing power your money will have. Okay. And so, like, say if you have a certain amount of money, like $1,000 now, and there's a real interest rate of 2%. Okay. What that basically means is that the purchasing power of that $1,000 is going to increase by 2% each year. Okay? Okay. And so in the notes, the terminology that's used in the lecture notes can be a little bit confusing because what I've written in the lecture notes is that this excludes the effects of inflation. Okay. Which might seem a little bit backwards at first because this is we're considering purchasing power here. Okay? But what I mean by that is that this real interest rate basically says that if inflation, if we kind of account for that already in our calculations, then we basically get something that's the real interest rate. Okay. And so what that means that kind of like what we discussed, that even though over time you invest a certain amount of money, that money is growing at a rate, and we'll go over that, which is the market interest rate. Okay? At the same time, inflation is causing the price of goods to also increase. Okay? And so what the real interest rate represents is that if you have your money growing at this rate and prices are growing at this rate, the real interest rate basically tells you how much purchasing power, how much more purchasing power you're going to have from your investment. Okay? And so that's why it's called the inflation-free interest rate. So if you have a real interest rate, you can basically, you can say that, I'm ignoring the effects of inflation because it's already kind of baked into my real interest rate. And, yeah, okay. Okay. And so it's not inflation free from the sense that we got rid of inflation. It's just that it's already kind of accounted for in the real interest rate. So if you're given a real interest rate in a problem, or you're using real interest rates for economic calculations, it's already in there. So you don't need to account for inflation again, because it already was accounted for. Okay. Okay. And so the last rate that we went over was the market rate. And so the market rate basically describes, how much your raw money is growing per year. Okay. And so the market rate is usually what you'll obtain from loans and bank investments, etc. And so if you take your money to a bank and you invest it in a, in some kind of mutual fund or something, then, the interest rate that they're giving you is the market rate, because that's how much your raw, your raw cash is going to be growing. Okay. And so these three, rates right here are related. Okay. And so the formula that we have for that is I, where I right here is our market rate. Okay. Is equal to I prime, where I prime here is our real rate, plus the inflation rate, plus the product between the real interest rate and the inflation rate. Okay. And so F right here, this is the inflation rate. Okay. And so one good rule of thumb that you can do when you're doing problems is that generally the real interest rate is less than the market rate. Okay. And that's because, even if you invest something at the market rate and your amount of cash is growing, prices are also growing at a rate at the same time. Okay? So the amount of purchasing power that you're gaining is kind of, you can almost think as the difference in between the market rate and the inflation rate. It's not exactly the difference because we have this kind of extra cross term right here. Okay, so that's I prime F. Okay, and so because of that cross term, it's not exactly the difference, but it's conceptual. You can kind of think of it like that. Okay. Okay. And so from there, then we launched into a discussion about the types of money that's associated with inflation. Okay. So there's lots of different vocabulary. Okay. Okay. All right. So the first type of money that we went over was actual dollars. Right. And so actual dollars, this is, actual money that that you can, touch in your pockets or that you have in your accounts. Okay. Okay. And so, this is your actual money. Okay? And so oftentimes, as you'll see when we kind of review our 4 rules, is that this is often associated with your market rate. Okay? Okay. Right. Because remember, the market rate is the rate that banks and investments will give you on your actual money. Okay. Okay. So that's actual dollars. Now let's go over real dollars. Okay. Okay. And so real dollars are not actually real, despite what the name states. And so real dollars is not actually money, but it's more of a theoretical concept that represents purchasing power. Okay. And so the most important thing with real dollars is that it has to be associated with some time period. Okay. Okay. And so in other words, your real dollars have to have some kind of base. Okay. Because if real dollars represent some kind of purchasing power, then purchasing power will change over time, right? And we've kind of already seen that with inflation. And so if you're quantifying the purchasing power, you can't just say just purchasing power. It has to be in some base, okay? Because the purchasing power back in 1982 is going to be different than the purchasing power here in 2020 because prices have gone up pretty significantly, from 1982, okay? Okay. And so when you're working with real dollars, since it's a, it's something that has to do with purchasing power, we often use our real interest rate. Because remember, the real interest rate represents how much purchasing power grows over time. Okay, and so if you want to compute that for real dollars, you have to use the real interest rate. Okay. Okay. And so those are our two types of dollars. And so from here, we went over our 4 rules for conversions. Because when you have, all these different types of money, all these different types of rates, you want to really use the right rates for the right, purpose. Okay. So let's review our 4 rules. Okay. And 2 of them we kind of already seen in here, but let me write out the rules on the other side. Okay. Okay. And so our first rule has to do with actual dollars. Okay. And so when you're converting actual dollars in one period to actual dollars in another time period, use the market rate. Okay. And so intuitively, this makes sense because, basically what this situation covers is, just a raw investment, right? And so you take a certain amount of money that you have now, you invest it in a bank, and then, you withdraw the money later, and then the actual money that you withdraw is going to be bigger than the money that you put in. And the rate at which it grew was the market rate, which is the rate that the bank gave you. Okay. And so when you're converting actual to actual, use the market rate. Okay. So that's pretty simple. Okay. And so the second rule is for real dollars. Okay. So when you're converting real dollars with some time base to real dollars in another time base, use the real interest rate. Okay. Oh, sorry. Real dollars at another time with the same time base. Okay. Use the real rate. Okay. Right. And so that caveat there is really important. So these real dollars have to have the same time base. Okay. Because what that's basically saying is that, if you have a certain amount of money and it's growing with time and the purchasing power is increasing, you can't have the purchasing power base change as you go forward in time. Okay. And so you need to have the same time base as you did, from once you started. Okay. And so in those cases, you have to use the real interest rate. Okay. So rule number 3. And so in rule number 3, when you're converting actual dollars in one time period with the real dollars in the same time period with the same time base, then use nothing. Okay. Okay. And so we'll say that, this is going to be actual dollars at time t to real dollars at time t. Okay. And these real dollars are based in that same time t. And so, if everything is in the same time, they're evaluated at the same time, and the real dollars have the same time base, then you apply no conversion. Okay? Because these represent the exact same thing. Okay? And so if you have actual dollars in 2020, so you have a $10 bill in your pocket, what that represents is $10 worth of purchasing power in 2020. Okay? And so if everything's at the same time, then those are all the same thing. So rule number 3 might seem like a very niche case at first, but this is how you actually convert in between the two at any given time. So this is it's a really convenient location time-wise, so that you can kind of convert in between these two dollars. Okay. All right. So those are the first 3 rules, and so the 4th rule is probably the most complicated one, but this is the only one where the inflation rate comes into play. Okay. And so in rule number 4, it basically says that when you're converting real dollars of some base t, okay, at some different time, okay, so we'll call that different time n, okay, and if we want to convert this to actual dollars, at that time n, okay, then in this case we apply our inflation rate, okay, for n minus t periods. Okay. Right. So this is the only time we apply our inflation rate. Okay. And so what this basically represents is that if you have actual dollars at some time and real dollars at some different time. Okay? So say like an example for this, like say we have $20 today, right? And so what we want to what we're curious to know is that how much purchasing power would this $20 have back at some other time. Okay. So back in maybe like in 1990 or something. Okay. And so in that particular case, you can use the inflation rate for the difference in between the time, okay? And so the difference between 2020 and 1990 is 30 years, okay? And so what you can do from that is you can apply the inflation rate for those 30 years, okay? Okay, so those are our 4 rules, right? And so there's lots of examples in the notes about this, okay? So I'll leave that for you to look at, okay? But I think the last thing that I want to review is this idea of price indices, okay? Because we're running pretty short on time, and I do want to start cooking my dinner. So I think we're gonna wrap it up here after price indices. Okay? And so price indices are a relatively simple concept. Okay, and so price indices are basically how the price of certain types of goods are tracked over time. Okay. Because usually for even though for a lot of problems we assume kind of a uniform inflation rate, in reality different products or different goods will inflate at different rates depending on a lot of different factors. Okay, and so the way price indices are represented is usually by given some score. Okay. Okay. And so the score is going to be for the very vast majority of cases going to be something over 100. Okay. And so the way that they get this number is that, at least for the consumer price report, which is, the one that I'm having you look at for the homework, what it does is that it looks at the prices for everything in 1982 to 1984. Okay. Okay. And so the price of these goods at that time are given a score of 100. Okay. So it's like 100%. And so in every year after that, what they do is that they look at the average price of that good, everywhere else, and then they take kind of the ratio of whatever the cost is now compared to the cost as it was in 1982 to 1984. Okay. Okay. And then from that, they multiply this by 100. And so that's how you get the price index for for that type of good. Okay. And so if you look at the consumer price report, you'll see things like the price of tobacco might have gone up, like it has a score of like 1,100. Okay. And so what that means is that the price of tobacco was increased by over 11 times ever since 1982 to 1984. Okay. And so the price index, it's a big number, it's a fancy term, but all it does is just expresses the relative change in cost over time. Okay. All right. And so that's all we got time for the review. So I know I spent a lot of time on taxes, but I really wanted to go slow through that example just to kind of give you another kind of a practice with that, because that the tax calculation get a little bit hairy. Okay. And then we also reviewed a lot of the definitions with regards to inflation. Okay, so when you're doing inflation problems, it's really important to keep these concepts in mind as you go through, okay? Especially the 4 rule, right? And so that's our review session. So I'm going to close the session here. So hopefully that was useful to everyone. And so if you have any more questions regarding the exam before Thursday, definitely let me know. I'm going to have my normal office hours on Monday and Tuesday. But besides that, you can shoot me an email or you can message me on the Discord. Okay? So best of luck to everyone studying. And I'll see you on Tuesday.